So let's go to IAS 41, agriculture. It's an interesting standard. You're going to love it. Now, IAS 41 agriculture follows the same principle from IAS 2 inventories. But there are a couple of terminologies that we just have to get used to and understand so that we can really go through this. So I'm going to go into our book. So there are a couple of terminologies that I would want us to take quickly, then we can get excited about it. Number one is biological assets. When we say biological asset, it simply means a living or a plant, a living animal or a living plant. That is a biological asset. Two, bearer plant. A bearer plant is simply a living plant that is used in the production or supply of agriculture produce. Stay with me. You need to understand agriculture produce and then bearer plant. Very, very important. Don't worry, I'll take you there in a moment. Agriculture produce then is the harvested product from biological assets. So a cow is a biological asset. The milk from the cow is an agricultural produce. Grapevine is a bearer plant. The fruit from the grapevine is an agricultural produce. Did you get that? That's the idea here. Let me dive you a little bit deeper on this one. So if we take plants such as tea bushes, grapevines, oil palms, rubber trees, all these are called bearer plants. And these plants, we account for them in accordance with IAS 16, property, plant, and equipment. So for the oil palm, the rubber trees, the grapevines, these ones are going to be accounted for in accordance with IAS 16. But the produce from the bearer plants, like the tea leaves we get for the tea bushes, the grapes we get from the grapevine, the oil palm fruit that we get from the from the oil palm tree, and then the latex, which is what we get from the rubber tree, becomes the agriculture produce. And that will be accounted for, these will be accounted for in accordance with IAS 41. That is the difference between bearer plants and agriculture produce. So now that we've looked at the terminologies, know what a biological asset is, what a biological produce is, the question we ask ourselves is, how the heck do we account for it in our financial statements? So let's go. I'm going to pull my slide up, then I'll come back to my writing part and write a couple of things for you. So measurement. Please stay with me carefully. Biological assets are measured both on initial recognition and at the year end or at the reporting date at fair value less cost to sell. Number two, agriculture produce at the point of harvest is also measured at fair value less cost to sell. Agriculture produce at the point of harvest is also measured at fair value less cost to sell. The fair value less cost to sell of agriculture produce becomes its cost under IAS 2. So what are we talking about? This is what we're talking about. If we have a cow, okay, and the cow will do two things. What's the name of a baby cow? I've forgotten. So we'll get a milk from the cow. What's the name of a baby cow? Calf. Ayo. Okay, calf. Thank you. Saito for no insurance yes anyoma we moye. To me verify window mun nyina yanko. So the milk, it's an agricultural produce. Okay? What we are saying here is that when we harvest the milk from the cow, at that point of harvesting the milk, it becomes something we will sell later on. So it becomes what? Inventory. So at the point of harvesting the milk from the cow, it will be accounted for at fair value less cost to sell. And then from there, we apply IAS what? 2, because it is now what? An inventory. The calf is a biological asset. A biological asset. So at the date of giving birth, that is the initial recognition. At the reporting date, the calf will all still be there. If some of them die, then we can write them off. But if all of them are still there, at the reporting date, we will still account for them in our books. What we are saying here is that at the initial recognition, it is measured at fair value less cost to sell. At the reporting date, it is measured at fair value less cost to sell. Any gain at the initial recognition and the reporting date is recognized in the P&L account. So it is just the common idea of what a double entry is like. So the calf is going to be a biological asset. So at initial recognition, we're going to debit biological asset and then credit who? Who do we credit? You didn't buy it to say credit cash. So that is why the credit entry will go to profit or loss. Are you getting the picture? Because recognition means we are incorporating it into our books. So the calf, we determine the fair value less cost to sell, multiply it by the number of calves we had, we get a value. That will be debited to biological assets on the face of the statement of financial position. Then the corresponding entry will go to the profit or loss. At the reporting date, like I said, the calf is still going to be there. So we measure it again. Fair value less cost to sell. Fair value less cost to sell. Then if there is any gain again, then we're going to be debiting biological assets again and credit what? Profit or loss. That is the meaning of the statement that we are making here, which is the final statement that changes in fair value less cost to sell are recognized in the profit or loss. Changes in fair value less cost to sell are recognized in the profit or loss. This is what we mean by the measurement of biological assets. That's the principle. Finally, where it is not possible to measure reliably, fair value reliably, they will be carried at cost less accumulated depreciation or impairment losses. So if we cannot reliably determine the fair value, then we'll carry it at its cost less accumulated depreciation or impairment losses. But somebody will say, I thought depreciation is about fixed assets. Yeah, you are right. I thought depreciation is about tangible assets. Yeah, you are right. But that is not all the picture there is. One thing you must understand is that as far as we are dealing with assets, okay, as far as we are dealing with assets, and especially we are dealing with non-current assets, when we cannot determine its fair value, it must be carried at the historical cost. I'll explain this to you in a sec under IAS 16, so stay with me. Now, when you carry something at historical cost, two things could happen. Either you have to charge depreciation on it, meaning you spread that cost over the economic useful life of the asset, or if it's not possible, you're going to test for impairment once every year. So, yes, we are dealing with biological assets, but don't see the depreciation as, where is this coming from? It is because of this principle that if we cannot determine the fair value of a non-current asset, it will be carried at its historical cost. That is the cost we incurred in acquiring that particular asset. Then, because we cannot determine its fair value, we will allocate that cost over the estimated economic useful life of the asset. And that is where, quote unquote, the depreciation will come in. But even if we don't know the estimated economic useful life of that particular asset because of the class that it belongs, then we have to test for impairment to see whether it has suffered an impairment. If it has, then that impairment loss will be recognized in the profit or loss.